Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. I am doing an impromptu recording of this episode. It is April 4th, 2025. And though I have an episode that I batched to originally release today, or the release date of this episode, I bumped that episode because I know that there are some people who are nervous about their investments due to the recent decline in the stock market. The S&P 500 index dropped 274.45 points, or 4.8% yesterday on April 3rd. And this is the worst single-day performance since 2020. The Dow Jones Industrial Average also dropped about 4%, and the Nasdaq Composite Index did worse, declining 6%. The year-to-date return of the S&P 500 is also a decrease of about 4.1%. It looks like we are going into a bear market, and there are calls that there is potentially a likely recession that may happen this year. During times like this, I know a lot of people get emotional about their investments. They get nervous, they get worried, and they start thinking about whether or not they should be selling. I want to encourage you to stay invested. Don't sell now, thinking that you'll reinvest it when the market is recovering. This is what we call market timing, and no one can consistently time the market. The last thing you want to do is buy high and sell low, and that's precisely what people do when they invest based on their emotions. When the market's going up and people are talking about how much money they're making, how much their portfolio is growing, then people are happy to invest and people start throwing money into the market. When the market starts going down, people get worried. They watch the market continue to go down. They watch the value of their portfolio go down, and often they pull the trigger and start selling right when the market is near its bottom. The market swings. It goes up and down. It's really a roller coaster. And when it becomes volatile, it's even more volatile. By the time recovery happens, you may have missed the best days. Many of the best days actually happen during periods of high volatility when people are most tempted to sell. Missing a handful of best days can significantly impact your long-term returns. If you stayed fully invested in the market between 2003 and 2023, a $10,000 investment at the beginning of that time would grow to around $64,844 at the end of 20 years for an annualized return of around 9.8%. This includes the 2008 recession and market drop. During that time, missing the 10 best days would cause the same $10,000 investment to be worth $29,708, which is less than half of that $64,000 by staying fully invested. Missing the 20 best days, and now your investment has dropped to a value of $16,421, which is a return of just around 2% per year, and that's not even quite keeping up with inflation. So if you actually miss the 20 best days over this 20-year period, then what could be a really good return on investment, now the money is actually worth less than initially because of inflation. What if you miss the 30 best days? Then your investment would actually be $9,359, and you would have actually lost money, not even including inflation. Yes, you may be thinking, that's great to hear, but how much more would you have if you missed the worst days in the market? It's true. By missing the worst days, your investment would grow significantly larger. Missing the 10 worst days in the last 20 years would actually more than double your return from around $64,000 to $122,683. Missing the 20 worst days gives you $213,383. And if you miss the 30 worst days, then your original $10,000 investment would be $380,337 for an annualized return of 21%. If you could manage to avoid the worst days, then you would massively increase your returns. But the fact of the matter is, people don't do that. The challenge is that most of the worst days are actually followed by the best days. The best days and the worst days are often fairly close together in time. That makes it really hard to be in on the days you want to be in and out on the days you want to be out. This is why timing the market is really a fool's game. If you miss out on the 10 best days and the 10 worst days, then your results are actually similar than if you stayed fully invested. Staying fully invested from 2003 to 2023 increased that $10,000 investment to $64,844. And if you missed the 10 best and 10 worst days, then you come out with $64,282, almost exactly the same. The same is true if you miss the 20 best and 20 worst days. The difference is that when you stay fully invested, you can spend time on the things you enjoy instead of constantly watching the stock market and trying to be lucky. Chances are, if you're trying to time the market, you're going to end up with lower returns than if you stayed fully invested. It is important to acknowledge that we tend to feel a lot worse when we lose money than if we miss out on gaining money. We feel bad when the market drops and relief instead of happiness when it recovers. The best thing is to ignore the day-to-day activity of the market so you don't even hear about the downturns. Despite the downturns that the stock market has had, the long-term trend of the stock market is upward due to growth from innovation as well as inflation. One of the reasons investing is so important is so that your money grows beyond the rate of inflation. Also consider that when you sell, you lock in your losses. This can be good if you're doing some tax loss harvesting, but in that case, you're also reinvesting immediately after you sell. The best thing to do when it comes to investing is to follow your investment plan and don't make decisions based on how you feel. Stop looking at how the market's trending. Keep up with your automatic investments. This is the benefit of dollar cost averaging. You buy more shares when the market is down. You may even want to follow the advice of Warren Buffett. Be greedy when others are fearful, and invest more when the market is downtrending. When you're investing for the long term, the market will recover. You can pick up some discounted prices when the market is down. And in fact, I did actually purchase some shares of VTI today. Interestingly, I also talked to my mother because she had cataract surgery yesterday, and she mentioned that she also had made purchases in VOO and VTI. Ask yourself, how would you be feeling if you didn't know what the stock market was doing? Would your life change at all? I was in medical school during the 2008 stock market crash. Well, I had already started investing by then. I actually don't remember being worried at all when the market crashed, and I certainly did not sell any of my investments. I was too busy being in my third-year rotations. My cash flow situation didn't change. I did have stock investments at that time. I had started investing in the stock market in 2005, but I also knew I was investing for the long run. My investments were mostly in retirement accounts where I couldn't easily touch that money for decades anyways. So I didn't. I just kept investing. And that has certainly helped me build my wealth today. I do remember at that time that there were patients who were expressing their concern. Some were retired and were worried they would run out of money. Perhaps you're not so young, and so you don't feel like you have such a long time horizon. Perhaps you're even considering retiring soon. Even if you are in your early 60s and contemplating retirement at the traditional age of 65, you still potentially have decades in your investing career. The average life expectancy in the United States is currently 79.4 years, according to www.macrotrends.net. A research study published in 2000 showed that U.S. male physicians were older than when they died compared to male lawyers, other male professionals, and men in general. That particular paper really just looked at men and didn't look at women. There was a recent paper published in JAMA that confirmed that male physicians do live longer, but sadly, it showed that women physicians had a higher mortality rate than male physicians, when women are usually found to have a higher life expectancy than men. But that's a discussion for another time. As an ophthalmologist, I see a lot of older patients, and I'm really finding that I have a lot more patients now in their 90s. I've even had a patient who is 100. 3 of my 4 grandparents lived into their 90s. So while tomorrow is never guaranteed, it's also very possible that you may be continuing to invest in the stock market for decades, even if you are in your 60s currently. What I want to offer you is that your thoughts create your feelings. If you hadn't heard about the downturn in the market, you would not be thinking about your investments. When you hear that the market dropped, then you may have started thinking about the money you've lost. When you're thinking about losing money, you may start to feel worried or concerned. The truth is, you haven't actually lost any money. You still own the same number of shares as you did before. Those shares may have decreased in value, but as long as you hold them, you haven't actually taken a loss. You haven't realized that value. Think about your own home if you own your home. You don't think about its value from day to day. There's no easy way to look up the value of your home at a given day or time, or at least no accurate way. You wouldn't even know if your home was worth less than when you bought it on any given day. You probably don't even worry about the value of your home until you're thinking about selling it. And typically when you're thinking about selling it, it's because you're considering moving or buying a different home. It doesn't have anything to do with the current value of your home. You're often not thinking about selling your home just because it's increased a lot in value. When you invest in stocks, you're investing for long-term goals. The stock market has always recovered from its previous bear markets. Even with the Great Depression, when the Dow Jones fell 89% from 1929 to 1932. Those who kept investing consistently after the crash and picking up stocks at discounted prices recovered within 5 to 10 years. I asked ChatGPT to actually give me some numbers. This is what it came up with. Let's say you had a portfolio of $1,000 in the stock market in 1929 before the Great Crash. It then drops 90% to $100 by 1932. If you continue to invest $100 a year in 1930, 1931, 1932, and so on, even as the market's going up and down and hasn't gotten to its low, your portfolio would have recovered to $1,000 by 1936. By 1942, your portfolio would have grown to be $3,236, more than triple your original portfolio. If you waited until 1932, after the bottom of the market, before you started investing the $100 per year, in 1942, your portfolio would only be $2,230. That's $1,000 less than if you just started investing even when the market was still going down and times looked bleak. The message of this story is to keep investing regardless of market conditions. Take a step back and think about your current situation. You likely have no change in income from your job if you're working. That's one advantage of being a physician. Our jobs are typically not affected by the economy. You probably have a fairly busy life. I know I do. My recommendation, stay busy, hopefully doing the things you enjoy. Stay investing and ignore the news media. If you do have a fear of investing or losing money, then that is when coaching can be so helpful. I've coached multiple physicians on feelings of money scarcity, not having enough, and fear of investing and losing money. Imagine feeling confident about your financial situation and feeling secure even when the stock market is tanking. What would that be worth to you? I love to help you get to that place of abundance. Set up a consultation call with me at www.growyourwealthymindset.com so that we can talk more about how I can help you. If you know someone else who could use my help, please share my information with them. Have a wonderful week, and thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.